Welcome to the deep dive. We're here to pull back the curtain on these huge global success stories, figure out what really makes them tick.
Right.
And today, wow, we've got a real head scratcher. How does someone build this billion-dollar beauty and fashion empire and at the same time have this one single business venture just completely crash and burn? We're talking, what, $34 to $37 million lost?
It's a huge contrast, isn't it? And that's our mission today. Forget the headlines for a minute. Let's dig into that specific failure, the one that cost tens of millions.
Okay.
Because there are real lessons hidden in there. Lessons for anyone, whether you're launching something massive or just a side project. The way markets punish mistakes.
Yeah.
It's pretty universal.
Okay, let's get into it. We're talking about Rihanna, obviously. From music superstar to, well, a serious business force. And that early music career, it wasn't just about fame, was it? It was like an education.
Oh, absolutely. A completely unconventional education, but incredibly effective. Think about it. That journey from Barbados, it wasn't just about getting famous.
Yeah.
It was this intense, hands-on masterclass. Every big collaboration, every endorsement deal. She was learning the language of big business, how branding works, how to leverage influence. She got that she wasn't just selling songs, she was selling influence.
Yeah.
And that really set the stage for everything that came next.
And those next steps, they weren't small, tentative moves. They were like earthquakes, starting with Fenty Beauty 2017.
Yeah, that launch. It's almost a perfect case study in disrupting a market. I mean, people knew something was coming, but I don't think the established players really understood the scale of the challenge.
Because the core idea was so simple, but powerful. Makeup for everyone. Inclusivity first. Something the big guys had, frankly, ignored for years.
They hadn't just ignored it, they'd actively failed at it. And Fenty Beauty didn't just talk about it. They launched with, 40 Shades of Foundation.
Instantly, yeah.
Which immediately made every other brand on the shelf look, exclusionary, out of touch.
And it wasn't just a PR stunt. It hit a real, massive, unmet need, that Fenty effect they talk about.
Exactly. That term popped up because stores sold out, within days. We looked at reports showing competitors scrambling, rushing out new shade ranges just months later, playing catch-up to a brand that was basically brand new.
So this is huge, right? It proves star power is potent, but only when it's combined with a genuine insight, a product people actually needed.
Right?
But she didn't stop there. 2019, she pivots again. Savage X Fenty lingerie.
And this move takes the whole Fenty brand into a much trickier space, apparel retail, soft goods. But she used the same playbook, right? Challenging the old norms, making inclusivity the main event. Those runway shows, they became these massive cultural moments. People weren't just lining up for bras, they were lining up to be part of a movement.
Okay, but hang on. If the formula star power plus inclusivity was working so well, why did the risk suddenly jump up with lingerie? How did that success actually expose her more? Because fashion retail, ready to wear. It operates on totally different principles. Much tighter margins, for one.
Okay.
And the logistics are just incredibly complex. Selling makeup is one thing, but apparel. You've got sizing issues, seasonal inventory you have to manage perfectly, complicated supply chains for different fabrics, much higher return rates.
Right, I see.
So that expansion proved the brand's power, definitely. But it also put her square in the middle of these really high-risk operational arenas, areas where tiny mistakes can cost you millions.
And that complexity, those risks, that leads us right to the big one, the shocking miscalculation. Because even the best stumble, but this is a big public fall.
It really was.
Yeah.
The venture that collapsed, it was this high-profile, very ambitious luxury play, specifically a high-end fashion and ready-to-wear lifestyle brand, basically trying to build a global luxury house from zero.
Okay, super ambitious.
Extremely.
And the price tag for walking away when it didn't work, the number we keep seeing is between $34 and $37 million. Gone. That's the estimate, yeah. Staggering number. And it wasn't just a financial hit. It was a cultural moment. People were genuinely shocked. Here's this icon. Everything she touches turns to gold. And suddenly there's this very public, very expensive failure.
And this is the key thing for you listening, right? This is the core lesson.
Exactly. It doesn't matter how famous you are, how much capital you have, how many fans adore you. You are not immune to market realities. That collapse was like watching risk play out in real time. It showed everyone that bad timing, execution errors, a saturated market, those things can sink any ship, no matter who's standing on the deck.
Okay, let's really break that down, the mechanics of why it failed. Because it wasn't just one thing, was it? You called it the triple threat. Timing, execution, saturation. Let's start with timing. Why was timing such a killer here? Surely with her resources, she could just ride out a dip.
You'd think so, but that's where the execution part comes in. She launched this high-end, ready-to-wear line right into a market that was already, frankly, drowning in established luxury brands and hot new designers.
So saturation.
Major saturation. And waiting wasn't really an option because the execution, the operations were already struggling. Think about luxury goods. The sourcing is incredibly complex. Custom fabrics, specialized manufacturing.
Right.
The lead times for producing this stuff could be 6 months. But fashion trends, they were shifting every 4 months, so they were constantly behind the curve.
Wow. So the operational engine just couldn't keep pace with the brand's speed and ambition. And if you can't get the product to the customer efficiently, or it's already looking dated when it lands, well, $37 million doesn't help you much then.
Precisely. And this is where that celebrity factor paradoxically became a weakness. We call it the celebrity blind spot.
Okay, explain that, because star power is usually seen as this massive advantage.
It is for acceleration,
Yeah.
for getting attention, but it can't replace deep operational and financial expertise.
But surely she had experienced people on the team. The reports suggest, though, that sometimes her influence might have kind of overridden expert advice. How does that actually play out?
Well, imagine this. You start assuming your brand loyalty automatically translates to sales, regardless of price point or market conditions.
Right.
So maybe a finance expert flags that your sell-through rates, how fast stuff is actually selling, are way too slow to justify ordering another massive expensive batch of inventory.
Yeah.
But maybe the decision makers, buoyed by social media buzz or just faith in the name, push ahead anyway. That's the blind spot, believing the hype over the hard numbers.
And that fame also created what you call the costly illusion. We, the public, just saw the glamour, the amazing launches, but behind the scenes.
Behind the scenes, the cash burn was enormous. Marketing, product development, just the operational overhead, it was quietly eating through capital.
Give us a sense of those costs.
Millions on star-studded campaigns, those incredibly elaborate launch events in Paris, New York.
Right, the spectacle.
Exactly. And even things like super high-end custom packaging. It all adds up, and it masks the underlying financial fragility. These costs ramp up way faster than in a typical startup because the expectation from day one is world-class luxury. There's zero room for error and zero patience.
And when you're burning cash that fast, I guess the investors start getting edgy.
Oh, absolutely. Investor pressure ramps up quickly. They bought into aggressive growth projections, this idea of exponential scale.
Which leads to trying to scale too fast.
It's a classic trap. The pressure for short-term results to justify the valuation creates this huge tension. You need long-term strategy, but you're being pushed for quarterly performance.
So what happens?
You try to expand too quickly, resources get spread thin, logistics start to buckle, products are late, quality control might slip because speed becomes the only thing that matters. You sacrifice the foundations for velocity.
And on top of all that internal pressure, there's the external spotlight. For a celebrity venture, every little wobble is potentially a headline.
Yeah, the public scrutiny is intense. It magnifies everything. A supply chain hiccup that might barely register for a private company. For a celebrity brand, it can become this massive crisis of confidence plastered everywhere.
It just amplifies the failure.
Dramatically. It turns small operational issues into these huge public relations disasters.
And somewhere in all this chaos, there must have been missed signals, right? Data that was screaming warnings.
You have to assume so. Sales patterns, market analytics, likely showed a mismatch between the really high price points and what the market was actually willing to bear consistently.
But they were moving too fast to see it.
Or maybe the high-speed decision-making, driven by that pressure we talked about, just overshadowed a careful read of the numbers. You know, the data on inventory levels or customer uptake was really saying, it's easy to get caught up in the momentum.
And maybe assume that just because a $50 lipstick flies off the shelves, a $1,500 jacket will too?
Exactly. That's a dangerous assumption. Different markets, different dynamics entirely.
Okay, so we have this huge public failure, $37 million, poof. But the story doesn't end there, does it? This is where it pivots. This loss somehow becomes an advantage, the power of the pivot.
This is maybe the most important lesson here. Failure isn't always the end. Sometimes it's just really, really expensive tuition.
Right.
And she showed incredible agility. She didn't double down on the failure. She strategically pulled back, refocused resources on the parts of the business that were working brilliantly. Beauty, the more accessible lingerie line.
Smart.
That ability to adapt, to pivot after a massive loss, actually turned a potential catastrophe into a long-term strategic gain. It forced a clarification of focus.
And crucially, she could absorb that hit because of diversification, right? The wild success of Fenty Beauty and Savage X Fenty, too, acted as a cushion.
Precisely. While a high-risk luxury experiment was bleeding cash, the beauty line was generating enormous profits.
Yeah.
It stabilized the whole enterprise.
So it proves the value of not putting all your eggs in one basket.
Absolutely. You need that balance. Profitable, proven ventures can fund the ambitious experiments. And it means a failure in one high-risk area doesn't take the whole empire down.
So when we look at Rihanna now, a certified billionaire, a mogul, that $37 million loss wasn't the end of the story. You call it the invisible engine. What do you mean by that?
I mean, it wasn't just a loss. It was a catalyst. It forced a kind of discipline and education that maybe wouldn't have happened otherwise. It fundamentally shifted the approach. Less focus purely on image, perhaps, and much more on operational structure, on financial rigor. That painful experience sharpened her instincts. It pushed her transition from being just an influential celebrity to being a really calculated, disciplined business strategist.
So the resilience, the structure we see now, it was forged in that fire.
You could say that. The legacy isn't just the success. It's the blueprint for resilience that was built out of that very public, very expensive setback. Hashtag tag outro.
So let's bring this home. What's the big takeaway here for you, listening now, maybe navigating the creator economy or building your own thing? You think it boils down to this. Ownership isn't just about power. It's about permanence.
Yeah, that's a great way to put it. Because look around today, especially in the influencer world, you see so many creators making similar, maybe less costly, but similar early mistakes.
Like what?
Like lending their name, their image, their influence to products or companies where they don't have real operational control, where they don't have significant equity.
Right, the quick sponsorship deals.
Exactly. It looks shiny on the surface, lots of followers, big endorsement checks. But if you don't control the supply chain, the finances, the actual strategy, most of the long-term value, and crucially, the control over risk, it's sitting somewhere else.
So every time you trade your fame just for a check without getting real skin in the game, real control, you're potentially repeating that early vulnerability.
It's a quiet warning, maybe, in this very loud world of endorsements. Control the product, or eventually the product or its failure will control you.
Powerful.
And that brings us to our final thought for you to chew on. Think about this. Those numbers, $34 million, $37 million, they once represented this massive, painful failure.
Yeah.
But now they're part of the origin story. They're almost like the necessary prerequisite for the billion-dollar portfolio that exists today. The collapse didn't end her business journey. It forced the rebuild, made it stronger.
So the question for you is...
Ask yourself, what about your own setbacks? Those expensive lessons, the failures maybe you're trying hard to forget? Could they actually be the silent prologue, the unseen foundation for whatever your version of dominance looks like down the road?